Hello everyone, my name is Sethi. I hope you all are staying healthy. Today we are going to talk about so many theories of investment like flexible accelerator theory, profit theory, Dusenberry, financial investment theory and internal fund theory. First of all, we will see flexible accelerator theory. Flexible accelerator theory is a realistic version of simple accelerator theory. According to simple accelerator theory, firm instantly buy machinery, tools, equipment as they require. But according to this theory, firm need some time to fill the gap between desire and actual investment. That means this theory acknowledge adjusting capital takes time, money and planning. In short, this theory suggests firm close the gap between actual capital and desired capital gradually rather than at once. So when demand for product increase, instead of immediately investing, company goes through all these six stages. Use existing stock. First of all, they use their old stock which they already have. They can also do work harder. For example, instead of operating machine for 8 hours, they start operating machine for 12 hours. Decision making lag. Manager need some time to decide. Currently manager is analyzing whether this increase in demand is temporary or permanent. Administrative lag. We require some time for paperwork, permission, even sometime we need government approval also. Financial lag. We need some time to arrange money, whether we are using our internal fund or borrowing money. All these things require time. Delivery lag. You have placed order, but still you need some time to make their place or for delivery. IT represent net investment in current period. K star represent desired level of capital stock. KT minus 1 represent actual capital existing from previous period. Lambda represent coefficient of adjustment. In simple accelerator model, lambda is equal to 1, that means firm will instantly invest. But in this model, lambda lies between 0 and 1. If lambda is 0.4, that means firm will close the gap between actual and desired investment about 40%, and remaining gap it will close next year because the capital investment needs some time. Profit theory of investment. According to this theory, investment depend on profit. How much you invest, it all depend on how much are you earning. So profit is biggest driver to buy new machinery, tools, equipments, even technology. Investment depend on two type of profit, past or current profit. This profit provide a fund to buy new assets without borrowing money. Expected future profit. This investment provide incentive to expand. If currently businesses are more profitable, that means their expectancy about profit will high. Eventually they will invest more. High profit leads to high retain earning. High retain earning leads to high ability to invest. Here you can see investment in current period, profit in current period, profit in previous period. So investment is function of profit. You can also write like this, investment dependent variable, profit PT independent variable. Investment depend on profit. B represent propensity to invest. That means how much investment increase due to increase in profit. A represent autonomous investment. Autonomous investment means you invest when your profit is zero. James Dusenberry theory of financial investment. According to this theory, capital investment decision depend on cost of capital. And cost of capital depend on which source of fund are you using. This theory identified three source of fund. Retain earning, this money you have already earned and keep in bank. This is cheap source of fund because you need not to pay any interest rate, and you also need not to pay some part of your profit as a dividend. You just have opportunity cost when you using retain earning. Opportunity cost means you are losing chance of using your money in somewhere else. External fund. External fund means you borrow money from banks. This is expensive source of fund. Obviously, you need to pay interest rate every month, and bank will charge more interest rate if you borrow so much money from bank. Equity, selling share to public. This is also expensive source of fund because every month you have to pay some part of your profit as a dividend. This theory talks about marginal cost of a fund. Initially, when you are using your retained earning, your marginal cost of fund will remain constant, equal to market interest rate. But suppose your internal fund exhausted, now you borrow money from market. As a result, your marginal cost of fund start increasing. Now you need more money, so you start selling your share in public, so your marginal cost of fund increase more. This curve shows the marginal cost of fund. According to Dusenberry, optimum level of investment is determined where marginal efficiency of investment equal to marginal cost of a fund. This curve shows marginal efficiency of investment. This is downward due to diminishing marginal productivity of capital. This curve shows marginal cost of a fund. At this E point, both are equal, both intersect each other. That's why OI will be called optimum level of investment. Internal fund theory of investment. According to this theory, investment decisions depend on internal financial position of firm, especially their retained earning and liquidity asset. That means a firm prefer to use their own cheaper internal fund like retained earning rather than going for expensive sources of fund like loans or issuing a share. IT, net investment at time T. ST, level of internal saving, or you can say the retained earning. LT, level of liquidity assets or cash. Pi T, profitability of a firm. So according to this theory, investment is function of ST, LT and Pi T. Why firm prefer to use their internal fund? Cost of capital. Internal fund has no flotation cost like cost of fee for issuing share, bonds, financial independence. If you are using your own fund, that means creditor and shareholders cannot control your management decisions. Market image. If you are using your internal fund, you have strong market image. An internal fund, according to this theory, mainly divided into two parts: retain earning, secondly depreciation reserve. That means money that you keep aside for wear and tear purpose. So this is all about today's video. I think you got it, and thank you so much for watching this video. Bye, take care.